what is happening in the entire SME IPOs. There are indications that the regulatory oversight and regulatory scrutiny for on merchant bankers which are active in the IPO market, that will go high. That is largely because of governance standards which have been compromised. That is largely because what has been disclosed, it is not really in the right spirit of disclosure. And this is largely because, unfortunately, merchant bankers have not followed their fiduciary duty. In the SME market, there are merchant bankers who are currently not really doing what could be called as even fit and proper check before they are taking the companies public. The regulator has expressed their concerns, and they have expressed their concerns in some of the IPOs. Rakifisol is one of the IPOs where concerns have been there. This is what SEBI, Mr. Bharti indicated. Be a good doctor to companies. Don't prescribe steroids when paracetamol is required. Merchant bankers should learn to say no, but nobody is saying no to SME IPO applicants. What needs to be done? Let's take the conversation forward with Mohit Gulati, CIO and Managing Partner with ITI Growth Opportunity Funds, and Sunil Subramaniam. Hi Sunil, good morning. Mohit, good morning to you. Thank you both for joining us. Am I right in saying, Sunil, when I say that right now merchant bankers who are taking some of the SME IPOs public, they are not doing their fiduciary duty? They are like the SEBI whole-time director, Mr. Bhatia, said that they are prescribing steroids when paracetamol can do the work.
I think absolutely, because if you look at it, the situation is that you have a gullible investing public. You look at the stories around the F&O story, the margin trading story, the demat account, people just buying stocks. So there is what you used to call in Hindi the hawa, right? So in this place, all it needs is a good story for people to buy it. And it's gone to such an extent that I got a WhatsApp forward saying somebody's got 10 tickets to the Coldplay concert and wants to launch an IPO. So that's the extent to which this has become. And fin influencers are also a part of this. People recommending and hearsay, people saying my thing. So today you just present a good story, people are willing to buy. And some of the recent IPOs doubling just the day after listing are adding to this frenzy. But it's the institutional segment, the merchant bankers, who need to be disciplined, who need to not use everything as a revenue earning opportunity. And I think SEBI, Mr. Bhatia's thinking is in the right direction. And I think you'll soon see some level of regulations come into play in this space. And that's the only way to control it, because people today, unfortunately, because of the markets going up every day, are thinking that the markets are a money printing machine, and so it's very difficult to prevent those people from doing it. It's only the discipline from the supply side. Demand is exorbitant. The supply needs to be controlled, managed, and I think absolutely I agree with Mr. Bhatia's thing. And there is this froth in the IPO market in the SME space. Absolutely.
What is a function of sometimes liquidity, demand? Right now there is strong price action, and as a result there is a lot of demand which is coming in. But what perhaps we are discussing here is that in many cases, I'm not using some cases, I'm using many cases, merchant bankers, Mohit, are not following with their fiduciary responsibility. Governance standards are compromised. The quality of disclosure is not something which is up to the mark. Is that a valid concern, and do you think that needs to be addressed urgently?
I think we are in a moment of such euphoria that it's not just you can't just leave the onus on the merchant bankers, right? It's collective greed. All of India is today greedy to make a better living for themselves, to make a higher net worth for themselves. People want to attain FIRE, which is financially independent, retire early. So across the board, okay. So let's start. Take the whole funnel. The greed begins from the minds of promoters who say, okay, I've not had access to capital. Banks give me loans. I mean, the core principle of SME exchange was really, really well thought. That can SMEs be able to tap capital markets to raise capital for themselves versus just depend on bank loans? Somewhere along the line, what has happened is we have gamified this entire process. So the gullible promoters came to bankers and said, we want to raise capital. And bankers have realized that, okay, this is an exchange in which we can actually build out a full stack story and profiteer from all sides. So right from the valuers to the bankers to the marketeers to the finfluencers to everyone to websites which are promoting SME IPOs to host of people, everyone has been involved in this overall greed making. Ultimate beneficiary is the entire value chain besides the retail trader who unfortunately will be left with holding onto junk which will fall between 50 to 80% in the near future. There's a very interesting economic theory which is called a reverse stock market crash. The key fundamental constituents of that are rapid price increases, disconnect from fundamentals, speculative behavior, potential bubble formation, increased wealth inequality. So what happens is in the wealth inequality, the larger market participants, so people who are the market makers or so-called the anchor investors, they continue to profit here, right? On a large check, they will keep making larger mark to markets, and continue to get bigger, while the smaller guys, keep on making these mistakes, and that's what leads to a sudden fall. So this is exactly how I summarize this whole SME segment. It's very unfortunate the way we've brought it here. Um, and I think the onus has to, go on everyone, including the regulator, who in their mind wanted to do something very well for the SME exchange. Unfortunately, I think, in the Hindi muhavra, right? Fir pastavat hot kya jab chidiya chug jaye khet. We are too far into this now. I don't know how do we get back.
Sunil, okay, I'm just going to recap it for our viewers. The idea of capital market is that companies can raise capital. The idea of getting this SME platform was that, when smaller companies, they can raise money via the capital market, and especially the innovative companies who do not have that kind of an access to, let's say, bank credit. Companies go public, they go to the IPO market, and then they are able to get value for their enterprise. But what is happening in the SME market right now, whether it is greed, whether it is oversight, whether it is participation, or whether it is froth, stocks are now trading at P multiples which are way higher than even large cap stocks. Response is massive, and liquidity is ensuring that whatever merchant bankers are selling, despite poor disclosure, that is getting lapped up. But like Mohit said, Sunil, that we are too much deep now in, which is that if you start unwinding, things may just collapse like a pack of cards. So the way in is what we know, but it is almost becoming like this Abhimanyu ka chakra view, that you know how to get in, you don't know how to get out. Right, Sunil?
Yes, absolutely. And so a
Abhimanyu ka
programmed
chakra
exit,
view.
Chakraview, but also, they can never have a programmed exit from a California gold rush kind of a scenario, right? Which is exactly what's happening. And let's take a parallel to the fact that this is something that should come under the MRTP, according to me, the Monopolies and Restricted Trade Practices. Because what's happening is there's a limited supply, phenomenal demand. So the supply makers, which is the companies, promoters, as well as the merchant bankers, are taking advantage of this and pricing this at unrealistic levels, right? So it's like selling a bottle of distillery which sells at 10 rupees in Mumbai. In the Thar desert, you charge 1,000, people buy because the demand is so high. Should you allow that to happen, right? This is exorbitant profit making. So I think the regulator has to first put curbs on the merchant bankers. If you're, as you're saying, diligence of them, and if they have found fault, there should be severe and strict punishment on the institutional piece of the business. That's one. Second is what this is also leading to is the raising of capital when it's not needed. Promoters are now looking to cash out rather than raise money. As you said, and as the previous speaker said, this is meant to be a substitute to raise equity, right? So that bank financing can then balance it and the SME can grow. But today, what's happening is that SME promoters are just cashing out their holdings just to make money. And that's unhealthy, because one way of looking at it when somebody lists his stock or gives it away is to say that I'm raising money to make better money for you. That's not the case. He's making money for his pocket. So it's a very unhealthy paradigm right now. And I think that you can't control the retail frenzy because it's all over there. Thanks to the internet and the YouTube and the fin influencers, it's everywhere. Oh, my stock doubled, my stock tripled. So you cannot control that end of it. So the institutional end of it with regulation, with thing, and to make the listing guidelines far more severe, the due diligence requirement by merchant bankers, I think that's the only way you can achieve some level of a programmed wind down of this frenzy, right? But I'm not very confident that that can happen. And I think a crash in the SME IPO could be happening anytime, and hundreds of retail investors are going to then be crying at the doors of the regulators. The opposition party is going to come and say, what has the regulator been doing? So it's not a very clean situation right now. It is a bit messy, and we might wish to have a programmed wind down of these what do you call unbelievable prices, but markets tell you that that's not the way it happens. Inevitably, a crash in that particular segment will result sometime in the future. They could be a month from now or 6 months from now. We don't know how long this frenzy can last.
So just gauging by what the both of you are saying, it really seems necessary for the regulator to come down with stricter norms. And, Mohit, given that you said that a lot of these retail investors are also getting trapped in the SME IPOs, what is now the way forward? The regulator seems to be tightening its grip when it comes to SME IPOs. So what should be the approach or the advice for investors?
I think, sorry, I have a slightly more diverse and a very macro-oriented view, right? I think as investors, so firstly, all of India has turned into a speculative investor of sorts, right? So let's take a step back and let's actually go back to building businesses, right? I come from a world of venture capital. Our idea is build businesses, right? Unfortunately, what's happened is India has about close to 10 to 11 million children who pass out of graduation colleges on a yearly basis. And we only create about close to 2.1 million odd jobs between private and public put together. So we still have a balance of 7-8 million jobs that we need to create. Mostly SMEs and MSMEs used to fill in that balance. Unfortunately, what's happened now is everyone's realized that, why should I work if I can start with some capital and invest in the markets and say make anywhere. And I know enough and more people who are saying, our only objective in the market is to make between 2 to 10,000 rupees a day via short-term trades. And then why should I work for anyone or why should I need a job? We need to change that mindset, right? If you look at the greatest companies that BSE 500 or NSE 50 have, right? They've been businesses where promoters have actually kept on just building their businesses, and listing was an eventual outcome. Look at Radhakishan Damani and what DMart's built out, right? So I think we need to go back to building businesses versus just speculating on others' businesses and on the markets. That is, I think, the key essential thing. Once retailers start using that money to either build capital businesses for themselves, which in turn could be much larger in their profits and everything else, versus just full time being traders and investors. So if that happens, automatically you start seeing some bit of liquidity drying away from SME. Currently, the problem with India is that people don't know what to do with their capital because of our slightly stringent GST norms. We don't encourage spending as much, unlike in the US or in China. So a lot of money, which is on the sidelines, which is discretionary, is again going back to the markets, which keeps just sort of snowballing this entire cascading effect. So I think we have a slightly more macro question to answer. Job growth, business growth is more important versus companies, stock growth or PE multiple growth.
Okay, thank you so much, gentlemen, for joining in and sharing with us your outlook on what the SME IPO rush is all about, the regulators' view, and how retail investors as well should avoid getting their fingers burnt.
If you like this video, then like, share and subscribe to ET Now.